Top 10 Facts on Business Analysis Techniques, NPV Calculation. Explanation: Net Present Value, NPV, is a financial metric used to evaluate the profitability of an investment or project by comparing the present value of expected cash flows with the initial investment. Here are the top 10 facts about NPV calculation. Definition: NPV is the difference between the present value of cash inflows and the present value of cash outflows associated with an investment or project. It represents the net value of expected cash flows in today's dollars, accounting for the time value of money. Time value of money, NPV takes into account the concept of time value of money, which states that a dollar received in the future is worth less than a dollar received today due to the opportunity cost of capital. NPV discounts future cash flows back to the present using a discount rate. Discount rate: the discount rate used in NPV calculation represents the required rate of return or the minimum rate of return expected from the investment. It reflects the risk and opportunity cost associated with the investment and is a critical input in NPV calculation. Cash flows: NPV calculation requires estimation of expected cash flows associated with the investment, including both cash inflows and cash outflows. Cash inflows represent the expected revenues or benefits, while cash outflows represent the expected costs or expenses. Initial investment: the initial investment is the upfront cost associated with the investment, such as the purchase price of an asset, the cost of capital, or the initial expenses incurred to start a project. It is an important input in NPV calculation. Decision rule: NPV is used as a decision-making tool to evaluate whether an investment or project is financially viable. The decision rule for NPV is that a positive NPV indicates a potentially profitable investment, while a negative NPV indicates a potential loss. Comparisons: NPV can be used to compare multiple investment options or projects to determine which one is the most financially attractive. Investments with higher NPV are generally considered more favorable, as they are expected to generate higher returns. Sensitivity analysis: NPV is sensitive to changes in key inputs, such as the discount rate, expected cash flows, and initial investment. Sensitivity analysis helps in understanding the impact of changes in these inputs on the NPV and the overall investment decision. Risk assessment: NPV calculation involves assessing the risk associated with an investment or project. Higher risk investments typically require higher discount rates, which can result in a lower NPV. Risk assessment is a crucial aspect of NPV calculation to make informed investment decisions. Limitations: NPV calculation has limitations, including assumptions about cash flow estimates, discount rate accuracy, and the inability to capture non-financial factors. It is important to consider these limitations and use NPV as one of the tools in conjunction with other financial and non-financial considerations. In conclusion, NPV is a widely used financial metric for evaluating the profitability of investments or projects. Understanding the key concepts and considerations in NPV calculation can aid in making informed investment decisions and assessing the financial viability of projects.